October 7th, 2019. It's Monday, another week here, guys, and I think it's going to be filled with plenty of awesome opportunities. The earnings season is officially kicking off. Tomorrow, we can have a really nice trade on Helen of Troy, ticker HELE. Domino's Pizza is announcing earnings tomorrow after market. This is going to be a great play because it does move quite a bit on earnings. So, guys, focus on these two. There's going to be some phenomenal opportunities in these two stocks. As far as today, we're keeping our short position on Tesla, adding more because we do think Tesla will visit the level of $212.50 in the next 48 hours. Quick and easy play here. Paying very close attention how CMG shares are going to be actually reacting to the reaction in Domino's Pizza. Recently, we've posted a breakdown on the restaurant sector. They're all highly correlated, so this Domino's Pizza report could have some very negative impact on the shares of CMG as well, as they trade together and have a very high correlation. With the stronger dollar, one of the top trades for this week is shorting BKNG. Carnival Cruise, ticker CCL, continuously gets downgraded, and they're slashing target prices on Carnival Cruise. Historically, BKNG and Carnival Cruise, they are highly correlated, so any negatives for CCL ultimately will project a negative in the trend of BKNG. So we're watching for a break in BKNG shares on higher volume at some point this week. Now, the puzzle to the earnings season is what we have been taking a closer look at over the weekend. Here's what's happening. We think we actually got the answer to how this earnings season is going to go. We've taken a closer look at the chart of oil, BTC, gold, NKD, USD, and we're going to share with you the details in just a second. Now, we've noticed this trend. There's some other companies that are filing for extra shares. They're selling shares. Basically, that happens when the markets are set in the top. So we're continuously seeing signs of markets or companies, the management making a decision to offer secondary offerings. Typically, when we see a lot of that type of activity, it is definitely a sign of a top in the market. Very important. Apple is, after all the bullish action last week, is finally showing some signs of losing its momentum pre-market, and so is Amazon. Amazon has just been in a funk over the last couple of months. In this funk, it just can't snap out of it. Trades on very thin volume. When it goes higher, and the volume increases every time Amazon moves lower. So both Amazon and Apple, sort of a representation today. The technology sector is stalling out here, and we got technology and financials stalling out. It's going to be tough for the market to move higher from here, so we're not expecting any huge upside potential here. Overall, we're still focusing on shorting the bounces. More importantly, guys, especially for those of you that are working with smaller accounts, this earnings season is powerful because you can use some very small resources to, turn situations like $1,000 into $5,000 on some of these earnings plays. But you have to be smart. You have to understand how to utilize this. So if you haven't taken Trade Like a Rockstar course, make sure you do so. A couple of earnings trades that we're going to be considering this week are right here. But next week is going to be earnings extravaganza. We're going to have so many companies reporting earnings after the week following this week. And the week after that is going to be actually the busiest week of the year. So get ready. You want to make sure you study up that Trade Like a Rockstar course so you understand all the details and how to take advantage of this earnings season. So with that said, pre-market, we are observing a lot of Move 11 type behavior. It looks like after a couple of days on Thursday, Friday, we had some bullish activity of institutions actually buying the dip. This behavior, again, is reversed pre-market. We're seeing a lot of these Move 11 type formations. The importance of that is futures last night on Sunday when they opened up for trading around 6 p.m. They actually did gap down. We hit a level right here of 29.28, roughly 29.27 area, and then bounced and started creating these Moves 11s. And it looks like the market is going sideways. But keep in mind that after a gap down, when you notice a bunch of Moves 11s, overall the market is pointing to a move lower, and so does our historical data. It does not mean that at some point today the market is not going to pop. We think it will, but that's going to present a great shorting opportunity. Bitcoin is down this morning, guys. we're noticing that this gap down is pretty much across the board. We've pointed out that there is a level in Bitcoin about 7,800. If it breaks below that, it can easily end up at about 4 or 5K rather quickly. So far, it's holding this level. It's likely to maybe try to attempt to close this gap, which is going to be crucial. If it's not able to close this gap, expect a move lower in Bitcoin, substantial in the next 72 hours. Now, if it does close the gap, it does show signs of strength, so we could be going sideways in Bitcoin before the bigger drop ultimately will take place. As pointed with this gap down, it's across the board, right? Shares in Japan, futures in Japan are opening with a gap down, almost identical like here in the United States. The move 11 here is a little bit more elaborate, and it's definitely a lot easier to see it, especially this is a 5-day chart, especially if you pull this chart on a 1 day, 1 minute. You can definitely see these moves 11 a lot more precisely in Japan. But when I inserted this chart, I didn't mean to just portray what Japan is doing, which is highly correlated with the United States market, but this is actually what's happening, guys, pre-market today all over the world. All European stock markets are gapping down. All the markets in Asia are gapping down. That is not a healthy type market condition after you have a substantial move higher. Basically, we're using this as another sign to get ready for a much bigger drop in the markets that's about to take place over the course of the next 7 to 10 days. Now, here's the confusing part. You may be thinking, okay, well, if you think the market is going to drop, why do you think then oil is not gold is not going higher? Well, as pointed out on Friday in the follow-up video over the weekend, guys, Federal Reserve did not sound desperate on Friday afternoon to continue lowering interest rates. So for that reason, gold seems to be topping out right here, creating these move 11s. And when you're trying to think about the upcoming earnings season, there's actually a very meaningful way in how you can utilize this information. Just basically think of this. The simple correlation is when interest rates drop, gold goes higher. Okay, just keep that in mind. Write it down to just simplify things for yourself. When there is a when there's a lower probability of Federal Reserve lowering rates, or even though they clearly are going to be lowering the rates, but maybe not as fast as the market expected, that is overall a negative for gold. Long term, as overall interest rates are going lower, that is overall a positive for gold, and gold will move higher. But short term, the reason why we're seeing the stop information in gold is because it's not happening. The interest rate cuts are not happening as fast as the market participant expects. So since it's not happening fast, then there's no reason to keep buying it right now. So therefore, you're seeing some selling in gold. It's not huge selling. It's just more like sort of consolidation. So oil basically could be trading between levels of 1470 and 1530 for some time before a bigger breakout. But the short-term move lower in gold is reasonable. Now, what it actually tells us, the most important part of this, when gold moves higher, in dollar terms, dollar actually climbs higher, and there's many reasons for the dollar to be climbing higher with all the Brexit possibilities. You know, the pound could take a huge hit against the dollar, so that's actually going to strengthen the dollar, considering all the negative rates already around the world, and still positive rates here in the United States. That's actually driving the strength in the dollar index as well. So when you take a look at a situation where you know, you compare the dollar to the world currencies, it's looking much stronger because the rates here in the United States, even though they're so low right now, they're historic lows, they're still higher than anywhere else in the world. From comparison-based perspective, it makes dollar stronger. And this is why you see this bullish chart on gold, where you recently, on dollar, you have this bullish chart on dollar. We recently have a bullish crossover. Dollar's clearly moving higher. It's a nice solid uptrend higher. Now, where things can get crazy if dollar actually breaks above 100 level, we're not far off of that. We're at 98.49. 99, right around that area. If gold, if dollar does break above that $100 mark, this is going to be a very, very strong headwind for United States companies that are going to be fixing to announce earnings here over the course of the next few weeks. So the puzzle basically is solved with the main condition: if dollar continues higher, it's going to be very difficult for companies, especially the companies that announce earnings here in the United States in dollars, but are doing a lot of sales and taking a lot of profits from overseas markets. They're all going to be hit pretty substantially, and actually BKNG is one of them. Think of all the bigger companies like Caterpillar and things like that. So we'll give you a good list of those stocks that could be hit the hardest based on this stronger dollar index. But keep this in mind: the strength of the dollar is going to make it very difficult, almost impossible, for the companies to report earnings beats. And if the companies are not going to beat earnings, it's going to be very difficult for the market to move higher from here. Now, clearly, one thing to consider is then local stocks, like, for example, Chipotle. It's a restaurant stock. It's not dependent on tariffs. It's not dependent on the dollar fluctuations. It's not dependent on the dollar index. Maybe with the exception of one of the main ingredients, which is guacamole, right, which is used heavily in Mexican type restaurants. So it's even with that, it's just not going to get impacted as much. So it would make sense that you would think, okay, well, institutions then they gotta unload Caterpillar and BKNG and all these stocks that derive a lot of income from overseas, and then they gotta buy stocks like CMG. But that is not what's happening either. So we're seeing a lot of institutions are taking their money even out of domestic stocks. So typically, the regular comment you will hear in the markets right now is they're talking about the rotation, how institutions are pulling money out of one sector and they're putting it in another sector. It's a bunch of BS. That is not what's happening at all, because we're seeing institutional selling pretty much across every sector. As we pointed out in one of the videos from a few days ago, we basically pulled up a bunch of charts from different sectors, and we're seeing institutional sellers across the board. So next couple of days are going to be crucial, because if Domino's Pizza has a negative report and it drops, the reaction is negative, then CMG is also going to drop. If dollar continues to drop, then all the companies with earnings overseas, they're going to get hit. And we're going to have a situation where they're selling domestic stocks, they're selling stocks, that are doing a lot of business overseas. Basically, it means that they're selling everything. And if that's the case, then the market is going to move lower, not higher. Pretty basic stuff. So just remember this: stronger dollar is bearish for all U.S. companies that are about to report earnings. Especially if they have large amount of profits coming from overseas. Write it down so you wouldn't forget about this. It should be very helpful with trading this earnings season, guys. The question of the day: will S&P 500 meaningfully break above 2946? 2946 was the level we're actually waiting for the market to drop below. And we calculated that part correctly. Unfortunately, the market stalled out at this level, 2855. Now we're back to the 2946. On the way lower, this was your support level. Now on the way higher, this is likely to be the resistance level. So can we overshoot a couple of points above 2946 today? Sure, but it's likely to be reversed. It is likely to be reversed because this is where a lot of sellers were bailing out. And so it is likely to serve as a very strong resistance level right here. So we want to short this level. If we see the market opening up anywhere around here, 2940, 2946 area, we want to buy puts. And then we want to wait and stair step later in the day. In either condition, if we see the market pop to 2950, we want to add puts. If we see the market start a reversion, moving lower below 2940, ultimately we do want to see the market move below 2931 mark, which is that magic 2931 level that we lowered to 2925. So any area of the market below 2931 and below 2925 area closed by 4 p.m. would indicate that the reversal is very much in progress. And we indeed as we pointed out in one of the videos yesterday, we are going to have circumstances where for the first time we have a shift in behavior, where typically when we're expecting a trade deal or any kind of positive news about trade, typically the market runs higher. I think the behavior is shifting as we're looking for these various charts, and what the charts are telling us, they will be selling. There is a great actually probability that the institutions will be selling today, tomorrow, and potentially Wednesday and Thursday in the week, in the expectation of a trade deal that they likely to get freaked out and just unload stuff. Because if you look at the probabilities, any talk related type situation about trade in the last year and a half has resulted in a pop and then a drop. So you would think by now institutions be like, damn, maybe, okay, we already know the ultimate outcome is going to be the drop. What if, okay, there's actually not going to be an initial pop? And the circumstances here on the charts, they point that there's a high probability of that, guys. Other than that, we're still heading lower after this possible pop that the market very much expects, which may not actually materialize. We're still going to work our way lower. So from 29.46, next stop 29, 22, 29.05, 28.91. All these levels you guys should be familiar with as we pointed them out. A very meaningful level for us to break would be the 28.51. If we break 28.51, we're going to be at 27.50 in no time. The trade of the day, nothing has changed on a Tesla chart. It was actually one of the weaker stocks on Friday, despite of the markets moving higher. This one just can't catch any momentum on the way higher at all. So short any pop in Tesla, same strikes that we're doing on Friday, 235, 230, 225, 222.5. Puts, first target, 212.5. Second target, 203, 204 area. Lock some gains there. The charts, we're not going to spend a lot of time on this, but guys, everything is bearish here, so any pop is to be shorted in Tesla. Okay, it's against the gap. It's got a lot of bearish reversal candles. It's the one to short now. Especially Tesla is the type of stock that likes to drop when overall the markets are holding up. So considering that the market could just be trending sideways in a range today for some time, Tesla is actually looking good based off its behavior that typically happens when the markets are not doing a whole lot. Now, Tesla is not the best stock to short when markets are dropping like crazy, because it has a tendency to have a negative correlation in a lot of instances where it doesn't drop as much, or it actually manages to stay positive while the rest of the markets are dropping. So considering the conditions today, market is still trying to figure out the direction from here. Tesla is a good short. So short some at the open, add some later in the day. That is a good short based on the charts, guys. October 4th on Friday was a move 1. That was the move 1. We gap up a little bit higher and continue higher through the rest of the day. 2-day sequence is 8-1, which is a typical sequence that you would see. We were actually expecting an 8-2, which had a low probability, but everything else was pointing to a drop in the market. It ended up being an 8-1. Now, I'm going to show you a very cool thing, what typically happens after an 8-1 sequence, which is very interesting in just a second, but this is how the 8-1 looks on the charts right here. As far as the 5-day sequence, we've got 6-2-3, 8-1. So overall, the market predominantly is highly bearish. So could we expect a pop back to this level of 29.94? Sure, but it's likely to be short-lived. There's a lot more things pointing to a reversal here rather than move higher. The move for today, the highest probability is actually, based on historical data, is a move 3. But considering the action in pre-market and some of the things, like Bitcoin is not breaking a level, all futures are not reversing, they actually are positive so far at the point I'm recording this. We think there's could be a probability of a move 4. So it's either going to be a move 3 or 4. Therefore, guys, do not overstay your welcome on the put side. If you open in put positions today, see about 12, 2 o'clock, The market is just reluctant to break for some key levels, which the key level for today would be that 29.31 area, 29.25. If the market is not below that level by 2:15, then you know it's time to lighten up on your put positions a little bit, okay? Now, this is what the historical data, the most recent case in the historical data of a move 8-1 was in November of 2018. Interestingly, very nice conditions that almost resemble current conditions down to a T. So we had a number of bearish moves preceding to this 8-1. So we had 3-3-11, so bear, 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 got an 8 followed by an 8-1. And look at the VIX, right? The VIX, and it actually happens to be Friday too, which is like insanely accurate. So we had an 8 on a Thursday back in November of 2018. We had a 1 on November 16th last year. Look at the VIX. It's exactly where the VIX is at in the last few days. So 20, 19, 18, 21, 19 and a half, 18. Friday, we actually ended up on the VIX at like 17, but majority of the day traded between, last couple of days right around these levels. Between 21 and 18 is where VIX has been. So we're not just pointing this circumstance here of an 8-1 because it coincides with Thursday, Friday, just like it did last week. But we're pointing this out because VIX conditions are very much similar to where they are right now. Now, after that, on a Monday, on the 19th, we got a move 3 with, again, VIX rising. And then the following day, on a Tuesday, we got another 3. So based on the historical data, I mean, we can easily very much see a setup like this. Where we're getting down slightly. Looks like pre-market at the time I'm recording this, maybe down, 8-10 points, and then could we maybe, go sideways a little bit and then drop further in the day? Sure, and then that actually sets us up for another move 3 tomorrow. Now this would be ideal repetition of what actually has taken place in November, and as you can see, VIX climbs all the way to 23.8. But then VIX starts to deteriorate and move lower. We still get a third bearish day. Then we actually went into Thanksgiving. And then after that, we had another bearish move followed by a couple of bullish moves. Look, VIX has basically stayed throughout all these conditions around 1920, 1920. So if VIX just continues around these levels, you guys know what happened in December of 2018. This is where all institutions were expecting, by the Santa Claus rally, and exactly the opposite took place, which we nailed based on our 13 market moves formula. And so considering the conditions, guys, this drop is near. We may not be timing it ideally down to the day, but it makes sense to position yourself towards a bigger drop taking place here in the near future based on the historical data. With that said, guys, VIX did make a move lower. However, overall, it's still numerically high and it is still uptrending, which tells you should be buying puts and even puts out of the money. Just remember, don't go crazy and don't buy puts way, way, way out of the money. In other words, don't be unreasonable. So will VIX hold this gap up is the ultimate question. VIX is up pre-market back to this 18 level. If it holds the gap, it's highly bullish. We can easily see VIX back to 21, 22, 23 area here in the next 72 hours. Everything is still very much highly bullish on the VIX chart. When you take a look at the longer time frame, all the bullish crossovers, they're very much there. They're not going anywhere. So the easy recommendation for the day is start buying puts at the open. Short any intraday bounce to 29.46, even a slight overshoot over that. Short some at the open is stair step later in the day. If market does not break below 29.31 by 2:15, then lighten up, take some gains, lighten up on some puts, okay, and just focus on trading small until we break through that level, which is essential. Once we're under 29.31, it should be a pretty smooth ride lower for a few days. So get ready for the bigger moves Wednesday, Thursday, Friday. Until we break that level, just trade a little light. With that said, guys, make it an awesome trading day. Get ready for the earnings season. I look forward to you guys' success. I'll catch you on the next trade soon.